Real estate is a fantastic investment. It can generate passive income and appreciate in value. But buying property directly can be a hassle. You need a large down payment. You're responsible for repairs and maintenance. You deal with tenants. Thankfully, there are ways to invest in real estate without actually owning property. These methods offer exposure to the real estate market without the traditional headaches. In this essay, we'll explore these alternative investment avenues. We'll discuss real estate investment trusts, or REITs, crowdfunding platforms, and real estate mutual funds. Each option has its own set of advantages and disadvantages. Understanding these will help you make informed decisions about your investment strategy. Imagine owning a piece of a shopping mall, an office building, or even a hotel, all through a single stock purchase. That's the power of real estate investment trusts, or REITs. REITs are companies that own, operate, or finance income-producing real estate. They allow you to invest in a diversified portfolio of properties without the burden of direct ownership. Here's how they work. REITs pool money from multiple investors. They use this capital to purchase and manage real estate assets. The income generated from these properties, primarily through rent payments, is then distributed to the REIT shareholders in the form of dividends. REITs offer several advantages for investors. First, they provide a steady stream of passive income. REITs are legally required to distribute at least 90% of their taxable income to shareholders as dividends. This makes them a great option for generating cash flow. Second, REITs offer built-in diversification. Instead of putting all your eggs in one property basket, REITs spread your investment across various properties and geographic locations. This diversification can help reduce risk. Third, REITs are highly liquid compared to physical real estate. You can buy and sell REIT shares on major stock exchanges just like regular stocks. This makes it easy to enter or exit your investment position. Finally, REITs offer the potential for long-term capital appreciation. As the value of the underlying real estate assets held by the REIT increases, so too can the value of your REIT shares. Crowdfunding has revolutionized the way we invest, and real estate is no exception. Real estate crowdfunding platforms connect individual investors with real estate developers and operators seeking funding for projects. Think of it as a way to pool your resources with others to invest in larger real estate ventures that might be otherwise inaccessible. These platforms offer a range of investment opportunities, from residential and commercial properties to development projects and even debt financing. You can browse projects, assess their potential returns, and invest an amount that aligns with your budget and risk tolerance. Crowdfunding can offer potentially higher returns compared to REITs. However, it's essential to remember that higher returns often come with higher risks. Section 5. Real Estate Mutual Funds. Diversification at your fingertips. Another way to invest in real estate without owning property is through real estate mutual funds. These funds pool money from multiple investors to invest in a diversified portfolio of REITs and real estate-related companies. This offers you instant diversification within the real estate sector, spreading your risk across a broader range of investments. Real estate mutual funds are managed by professional portfolio managers who make investment decisions on your behalf. They handle the research, analysis, and buying and selling of assets within the fund. This can be a significant advantage for investors who lack the time or expertise to manage their own real estate investments. Section 6. Weighing your options. REITs, crowdfunding, or mutual funds. Each real estate investment method comes with its own set of advantages and disadvantages. REITs offer liquidity, diversification, and steady income, but may have moderate returns. Crowdfunding presents potential for higher returns, but with increased risk and less liquidity. Real estate mutual funds provide professional management and diversification, but offer less control over individual investments. The best choice for you depends on your individual financial goals, risk tolerance, and investment timeline. If you're seeking passive income and long-term growth with moderate risk, REITs might be a suitable option. If you're comfortable with higher risk and seeking potentially higher returns, crowdfunding could be an avenue to explore. For those who prefer professional management and broad diversification, real estate mutual funds provide a hands-off approach. Section 7. REIT Deep Dive: Equity, Mortgage, and Hybrid REITs. Within the world of REITs, you'll encounter different types, each with its own investment strategy and risk profile. Equity REITs own and operate income-producing real estate, such as shopping malls, office buildings, and apartments. They generate revenue primarily from rent payments and benefit from property appreciation. Mortgage REITs, on the other hand, provide financing for real estate projects by lending money to borrowers or investing in mortgage-backed securities. They profit from the interest income earned on these loans. Hybrid REITs combine elements of both equity and mortgage REITs, offering a blend of income and potential appreciation. Investing in real estate crowdfunding requires careful consideration and due diligence. Before investing through any platform, thoroughly research the platform's track record, fees, and the types of projects they offer. Carefully scrutinize each project you're considering. Review the project details, financials, and the experience of the sponsors or developers involved. Remember, crowdfunding investments are typically illiquid, meaning you may not be able to easily access your money before the project's completion or a predetermined exit strategy. Diversify your crowdfunding investments across multiple projects and platforms to mitigate risk. Don't invest more than you can afford to lose, as with any investment. Section 9. Real estate mutual funds: active versus passive management. When choosing a real estate mutual fund, you'll encounter both actively and passively managed options. Actively managed funds have portfolio managers who actively buy and sell assets within the fund based on their market outlook and research. They aim to outperform a specific benchmark or index. Passively managed funds, on the other hand, track a specific real estate index or benchmark. They aim to replicate the returns of that index rather than trying to beat it. Actively managed funds typically have higher fees due to the research and trading involved. Passively managed funds offer lower fees but may not outperform in all market conditions. The best choice depends on your investment philosophy and whether you believe active management can consistently add value. Section 10. Building your real estate portfolio. A path to passive income. Investing in real estate without owning property provides accessible avenues for investors of all levels to participate in the potential benefits of the real estate market. Whether you choose REITs, crowdfunding, or real estate mutual funds, carefully consider your financial goals, risk tolerance, and investment timeline. Each method offers unique advantages and disadvantages. Diversifying your investments across different asset classes, including real estate, is crucial for a balanced and resilient portfolio. Remember, real estate investments are not without risk. Property values can fluctuate, interest rates can rise, and unforeseen economic events can impact the market. Conduct thorough research, seek advice from qualified financial professionals, and never invest more than you can afford to lose. With careful planning and informed decision-making, you can leverage these alternative investment methods to build a path towards financial freedom and generate passive income through the power of real estate.